It's painful. This is a Bitcoin bear market. Relative to historic bear markets, it's somewhat modest. If you look at past deep bear markets, we've seen 75% plus corrections. Right. Bitcoin fell from 126 peak in the fall, and it reached about 60,000 in February. So about a 50% drop down. So relatively modest compared to past Bitcoin bear markets, but obviously always painful in that moment.
Who is selling? Sweeney asked this question the other day. I'm stealing it from him. Who is selling?
Primarily people who have acquired Bitcoin in the past year and a half. So some of the metrics that we track are the cost basis for ETF holders or ETP holders. That's about $83,000 today. We also have a metric for the average cost basis for any holder of Bitcoin, and this is called the active investor cost basis. It does not include what's been rewarded to miners. And so that's about $78,000 today.
The average the average BitDog cost is what did you say?
$78,000.
I had no idea.
So if you think about it from that perspective, people in the past year and a half or so, they bought Bitcoin, they experienced a quick rally up to $126,000, and then quickly saw their entire investment get cut in half.
Wow. So who is, explain to us who the market is. Who is the Bitcoin or the crypto investor base here? Professional, retail, speculative? How do you guys look at that?
So this is primarily a individual market.
Okay.
It's historically been driven from individuals. You are seeing some institutions come in, but it's very early stages. To put some context around that, there are hedge funds in the space. About 30% of the spot ETP products are owned by hedge funds. The caveat there, it's market neutral. They're doing the basis trade. They're not taking directional views.
Is crime in the space? Is crime still using Bitcoin?
Probably, yes. But to be fair, crime is using every currency. And there's arguments for and against cryptocurrencies in this regard. Those who view it as a way to commit crime or be useful in crime would point to the fact that there's no KYC, anyone can use it. Those who would defend it against that would also make the point that it's not the best instrument to use for crime. There's literally a public record of every single transaction you do. So if you know what addresses are associated with individuals or entities, you're literally creating a permanent paper trail.
How is AI impacting crypto broadly defined?
So the biggest trend in the past couple of years that we've seen is Bitcoin miners pivoting some of their operations to high performance computing for AI data centers. So these miners, they can contract out inference and earn higher revenue per megawatt hour than they would for mining Bitcoin. And so historically, what we've seen is the network hash rate has had a high correlation with Bitcoin prices. The more miners are on the network, the higher prices have gone. And so typically those two things rise together. Pivoting operations to AI inference, it's better for miners.
Right.
You don't have to time Bitcoin sales. It's more stable revenue, and it's more profitable. But the thing with inference is people aren't using these models 24 hours a day. They're primarily using them during business hours. And so we actually think this is a long-term benefit to the Bitcoin mining industry. Instead of having people permanently pivot, during business hours, when it makes sense, you can do that inference.
I got to get this in. I got to get back to Bitcoin at 101. Jim Ferraioli killing it with us with Charles Schwab this morning. Raphael Auer and his team in Geneva at Bank of International Settlements is definitive on this. Terse 6, 7, 8 page, hugely researched papers on speculation, mining, whatever. Let me go back to Raphael Auer 101. What's the underlying? Apple's underlying is the expectation of free cash flow. The underlying of the Knicks is Brunson's going to get it done. What's the underlying of Bitcoin?
Energy. It costs money to produce Bitcoin. And our entire framework for investing in Bitcoin and cryptocurrencies comes down to minor metrics. There are energy costs and infrastructure costs associated with producing Bitcoin. In any product, theoretically, the price of a product should be at a premium to the cost of producing it. And so we can see this. We know for the best miners, those that have the cheapest energy costs and the most advanced fleets of ASICs, they produce Bitcoin at about $60,000 per Bitcoin.
Really? Wow.
Yeah. So historically,
I haven't heard that data point ever in my discussion of crypto.
So what does that mean within the micro, the Chicago price theory, well, the Seton Hall price theory of this? If 60,000 is my manufacturing cost, what does it mean for price? Are we going to go under 60? The answer is yes.
well, first, let me point out, as a Seton Hall grad, it's important to think about what this has done historically. In deep bear markets, for those top producing miners, their cost of production has served as a bottom. The average miner today, it costs them $95,000 to produce Bitcoin. They have higher energy costs, they have less efficient ASICs. And so they temporarily shut down operations when it becomes less profitable.